In today's episode, we're going to talk about, does IUL work? And specifically, we're going to talk about liquidity. We get a lot of questions or comments about, can you access money in an IUL in the first year, second year, the third year, and how much can you access? Sometimes people don't understand that these things can be very liquid and you can design them in different ways with more liquidity if you need it. So some business owners or people that need to access money in those early years. So we're going to talk about that today. Hi, I'm Aaron Andrew. I'm Doug Andrews' son. I'm here to take over today's session to talk to you about liquidity and does IUL really work? So I've been doing this for almost 20 years now. Been in the business a long time, 41 years old, been doing this a while, and I'm one of the co-authors on the Laser Fund book. Make sure you look at that book as well to understand more about liquidity. In particular, chapters 7 and 8. So chapter 8, we talk about being able to access money. We talk about how to access money the sad way, the dumb way, and the smart way. Of course, we're going to want to mainly focus on the smart way. I don't think anyone wants to do it the dumb way, but read the book and we'll talk about that some more, but let's just go over those briefly. So first of all, the sad way is by dying, of course, right? So if anyone passes away, you can see here, for example, on the screen, this 50-year-old, if they were to buy this policy to put in $500,000, you can see here that their death benefit would be almost $1.5 million. So if they passed away early, they're going to have a great payout for the family, which is a nice protection, but we don't recommend, the sad way, of course, but it's great there to be there for the family. The other way is the dumb way, and the dumb way to access money from an IUL policy is going to be taking withdrawals, because technically withdrawals, you can't put them back. All right. And also the withdrawals can be taxable. So you can do what's called a partial surrender or withdrawal from an IUL. But in that case, you can technically withdraw FIFO, what's called first in, first out. So the first money you put in, so this one here on the screen, for example, we put in $100,000 a year for 5 years. As we do that, that money is the first money that went in. So as the policy grows and you want to access money down the road, under FIFO treatment, we could technically take out that money we put in. And if you've watched a bunch of these other videos, you'll understand that any money you put into an IUL policy is after-tax dollars, which means money you've already paid taxes on. So we can technically take that money back out tax-free because we've already paid taxes on it. After that, so if we take out, $500,000 down the road out of this policy in withdrawals, then if you switch over and take out, or if you continue to take out withdrawals, you would be taxed. And you'd have to pay taxes, income taxes on those withdrawals because you'd be taking out your interest. So that's what we call the dumb way. No one does that. We don't want to take out withdrawals. We want to take out loans. Because with a loan is not deemed earned, passive, or portfolio income, the three types of income that we report on our taxes. So the IRS knows you're getting it, but it's not taxable because it's a loan. You're borrowing against your money that's inside the policy. Now, again, make sure you read chapter 8 of the Laser Fund book to learn more about how these loans are a positive, not a negative, because a lot of people misunderstand loans thinking that it's going to cost you a bunch of money. And yes, there is loan interest, but your money is in there as the collateral is going to continue to earn interest. So we're going to talk about that briefly as well. But let's get into this. Let's show you a couple of examples here. So let's go back and show you kind of a normal illustration here of what we want to look at inside of an IUL. So here's another example of a 50-year-old or 51-year-old putting in $100,000 a year for 5 years. We have to do that to comply with TAMRA, with the tax code. But right here, as you see, on the left side, this is if we earn a small return of 2.5%, right there. But if we earn more of like a 6% return, more of a low average or a historical average of these index accounts, you can see over here on the right that we would have $90,000 in the policy at the end of the first year. Now our net surrender value, that value right there is what is liquid to us. So death benefit is $1.3 million in this example. Accumulation value is $90,000. Surrender value $55,000, and death benefit just shy of $1.3 million. Every age and structure is going to be different. But in this example, we're talking about specifically liquidity. So this client can technically surrender the policy and get out $55,000, which would not be a smart thing to do. That's another category under the dumb method, would be to surrender it. We don't want to do that. But yes, in this example, we can access, just always remember this, you can access roughly about 80 to 90 to 95%, depending on the company, of your net surrender value in any given year. All right, so in this example here, $55,000, 80 to 90% of that number is liquid in the form of a loan. Some companies don't allow you to take loans until the second year, but a lot of them allow you to take money as soon as the first year. So this client puts in $100,000. We don't have access to all the money, but we have access to 80 to 90% of that $55,000 in the form of a loan. Now, when we say the word loan, you can always pay back a loan, right? So the client can always pay it back. You can always put money back in and pay off the loan anytime you want and put the money back into the policy. Okay, so this example is great. You can see this has what's called a surrender charge for 10 years. So let's just look at, for example, let's look at year 6. So by year 6, we finished funding the policy. At this point, we've got $551,000 in the policy if we average 6%. The surrender value is $530,000. So now at this point, we have access to 80 to 90% of $530,000 without, canceling the policy, taking a loan out for liquidity. Pretty neat. And if we passed away, still $1.3 million if you were to pass away in this example. Okay, but you can see by year 11 down here, by year 11, the accumulation value and the surrender value are the same. There's no longer what we call a surrender charge. So you have a penalty for the first 10 years if you were to cancel it. Now, watch this when I go to the next screen, and we're going to look at another example here. This is the exact same policy, but in this example, we are adding what we call a liquidity rider. So if a client wants to have more liquidity, if you want to have more liquidity in your policy in those beginning years, you can meet with us and talk to us and say, all right, we put in $100,000. I want to have more access to more money. So see how this account now has $90,000 in the accumulation value, $90,000 in the surrender value. So now there's no longer what we call a surrender charge. So we can add a rider, adds an extra cost. You can notice down here that instead of having $730,000 in there, we had $715,000. So instead of having $730,000, we have $715,000 because we added an extra cost for these next 10 years to add more liquidity to the policy. So we have real estate investors, business owners that add this rider sometimes, and it has to be added at the beginning, but they add that rider to have full access to their money where they can access, again, 80 to 90 to 95% of that number in the form of a loan, and then they can put it back. All right, so pretty cool. Now we can go even a step further and use a certain company here or different policy that has even more liquidity. Check out this one. So this one here, if a client really wants more liquidity, there's policies that have really low fees in the beginning years. So this is the one I had up at the beginning of the presentation. You can see we have 98,000. So you put in 100,000. We have 98,000 the first year. The surrender value is just barely underneath that by like $200. So we got $97,900 in the surrender value. So still a slight surrender charge, but look at that. 98,000 pretty much is liquid of our 100,000 that we put in the first year. So if you need liquidity, we can add a lot more liquidity with certain policies. Not all, but with certain policies, we can add a ton of liquidity if you need it. And once again, you can surrender it and take that money out. You can also access that money through a loan, okay? And take it out a loan, and then you could always put it back, of course. Now, in this example, you see how much more liquidity is. Let's use an example of showing a loan here. So here's the exact same policy. And in this example, we put in 100,000. And right here, we can show there's the max loan we were able to take out. So we took out $93,000 almost in the form of a loan that first year was our liquidity that we were able to take out. So you can see that the accumulation value and the net surrender value, these two numbers are down at the 2,000 range because we took out $93,000 in the form of loan and you used it for whatever, a real estate purchase or business purpose or whatever you needed it for. And there's the loan there. So the net outlay, we put in 100. We really only had $7,000 outlay because we got back $92,000 in the form of a loan and put that money back in our bank account or whatever we were going to do with it. So in this example, pretty cool. And I'm never showing us paying back that loan. So it gets paid off at death. So loans are paid off at death, basically, and is how these work. Let's go to another example. Here's another example of taking out the max loan for 2 years. So right here, we take out the loan for not 1 year, but the second year as well, take out 92. So you can see the net surrender value because we took out the max available, we have $800 left in there at the end of that year. Now we want to be careful not to take out too much and lapse the policy, because just like any financial product, you take all the money out and it's kind of done. There's nothing left in there, right? So you don't want to surrender or lapse the policy, but this shows the example of taking the max loans, okay? Now let's look at one more and show you paying it back. So in this example, if we have this client that puts in the money for 5 years, $100,000 a year for 5 years, we take out the max loan for 2 years, and then the next 3 years, we just pay the premium still of $100,000 a year for 5 years. But then, all of a sudden, we got done with that real estate transaction we did, or we, used it in our business or whatever. Now we want to pay off that loan. So in this example, we're paying off the loan of $211,000. That is the loans and the loan interest as well. So we pay back all the money into the policy, and now we have all of our money inside the policy now. Okay, we have $500,000, what we put in there before now. So in this example, it shows you the liquidity of being able to borrow from it, putting it back and so forth. And let me just give you kind of a story here. Let me go back to this one here, showing you liquidity in these. So these examples here, once again, we can have as much liquidity as having, putting in 100,000, having 90,000 in there and 90,000 liquid to us, and being able to borrow a good portion of that number if we need to. Or we can do one where we say, you know what, I want the one with the lowest charges, and I'm going to go with one like this, like the first one I showed. So this one right here shows an example of, we don't have as much liquidity in this example, but it's got the lowest charges and the most long-term potential because it's got the lowest fees in this structure. So we can design it any way you want. But let me just start and give you a couple examples of clients that have taken money out. So we have a client that a few years ago took out a big chunk of money to do a remodel or rebuild on their house. When they did that, they took out $1 million out of their policy and they didn't pay any taxes. Now think about it. What if you had that money? What if this client, or you have $1 million in an IRA or 401k? Would you take $1 million out all in 1 year to do a remodel or a rebuild on your house? Probably not, right? Because you would jump up into higher tax brackets taking all that money out. And if you were my age, at 41, you'd pay also a 10% penalty as well. But this client was able to take out $1 million out of his insurance policy in the form of a loan, okay? And by the way, there's a couple different loan options, but one loan option that's our favorite is you borrow at like 4 to 5% right now is what most companies charge. You borrow at 4 and 5%, but the money in the policy, because you did not withdraw money, you borrowed against it. So the money that's in the policy stays in there and continues to earn returns. So if we borrow at like 4.5%, let's say, on that $1 million, well, the $1 million that's in the policy, that's the collateral for the loan, that money gets to continue to earn interest. And if you've watched other videos, you know that these returns could be, 5%, they could be 10, they could be 15 or 20%. But let's say we earn 8. Let's say we earn 8% and borrow at 4.5. That is a huge arbitrage or a spread. It's pretty cool. So your money can stay in there continuing to earn interest when you borrow against it at a lower rate. Now, yes, some years you're going to earn 0 on the policy and your loan balance goes up by that 4.5%, let's say, and your cash value earns 0. That can happen too. So if you want to be more conservative, you can use what's called a fixed loan or a standard loan, where we might borrow it, for example, 2.25%. So a lot of policies will be different, but let's just use an example. So one, you borrow at 2.25%, and the collateral, the $1 million in the policy, earns 2.25%. So you borrow at 2.25%, the money in the policy earns 2.25%, and it's called a zero wash loan or a zero cost loan. Those are pretty cool. So you have 2 different loan options, and make sure you watch other videos that we talk about that with the loans to explain that in more detail. But let's go back to that client example. Taking out $1 million, he was able to do that for 1.5 years or 2 years, and then he was able to pay it back and put the money back into the policy. Think about an IRA or 401k. You couldn't take out $1 million, or you could, you'd pay a bunch of taxes, and then you couldn't put it back a year or 2 later. Same thing with like a brokerage account. You wouldn't want to take out $1 million sometimes because you might have a big gain and you have to pay taxes. Or you might have a big loss, and if you had a big loss, you would lock in those losses. And so sometimes you really think about it, a lot of other accounts aren't that liquid because of taxes, because of a 10% penalty. But the cool thing is about IUL is it is liquid. You can borrow from it. You can make it more liquid, as we showed in these other examples, and you can put it back, and you can do it at any age you want. It's pretty cool. So make sure that these policies are designed correctly. That's the most important thing, is making sure they're designed correctly and the way you want it. If you want more liquidity, we can put that in there. So I hope you learned something today about the loans and how these things are extremely liquid.